Been investing in real estate for the past 7 years and have over 100 doors, single-family, multifamily, and self-storage facilities as well. These are some of our, oh, thanks, Sean, appreciate it. There we go, yeah, all right, yeah. These are some of our facilities, just to kind of give a peek of what we acquire. All of this is in the Midwest. For the most part, all of our portfolios in the Midwest, except a little bit here in San Diego for myself. But you can see self-storage, multifamily, the whole gamut. And then track record about ourselves. We've transacted over $32 million between my business partner and myself, not necessarily within the fund, over the last 4 years. We've completed over 100 full cycle refinance or sale of properties that has resulted in over 100% return of capital back to us. We've never lost investor money, and we've never lost money on multifamily or self-storage. So kind of just track record about ourselves. And then focus area for us moving forward is continuing to acquire usually off-market properties out in the Midwest. We love the Midwest based on cash flow, opportunities out there, and my business partner half of the year lives out there. So that's the connection out to the Midwest. And then you can see this building. This is typically what we'll do. We'll renovate something that's a little bit more underperforming and bring it up to what we consider our standards and have some forced appreciation into the building. We're talking on cost segregation today, which is an exciting topic. Taxes usually are not that sexy, but saving money on taxes is very sexy. I should probably have a model jump up there or something like that. Like, ooh, yeah, shake it up. But anyway, this is an example. What you see here is actually a screenshot of a portion of a report from Carlos's company. And so what you're looking at here is this piece here is what's the most interesting piece right down here. So you can see accumulated depreciation with cost segregation, $132,341. Without cost segregation, $3,034. So that is the impact of cost segregation. So depreciation allows you to write off the depreciation against taxable income. And so you can accelerate that with current tax law to be able to have massive tax losses early on into a property acquisition. So that's the huge value add piece. Carlos is going to dive into it. He's going to wow you with all the tax savings and all like that. But I thought I'd give a specific example where we use this for self-storage and his company in particular that's really saved us money and our investors a ton of money as well. And then I'll end on actually a new deal that we're super pumped about. We're about to go under contract in next day or two, maybe Monday. But it's an off-market RV park that we sourced in Nebraska that currently has 84 pads and then significant expansion potential to over 225 overall pads. Maybe we'll do some additional storage there, some RV storage, boat storage, or just regular storage for people that are transient in and out. But you'll see here, like this is the overall plot of land. It goes into a jetty. There's a beach. Awesome place. Maybe next one we host out there and hang out on the beach. Maybe bring our RVs out. We might need to head out to Nebraska to do it. But then we can take our boats out to the river here, do some fishing. It's called Fisher's Cove. So that's the new facility. This is what we're looking to acquire, and just giving you guys a taste of things that we're out purchasing, looking to acquire out in the Midwest. And then why we're doing it, we love the returns. RV park wasn't necessarily the focus for us, but it's super attractive, got it off market, and then some untapped potential around being able to do short-term rental, camping, yurts. People want to be able to be out in nature, so that's the background of it. And then the cash on cash ends up being quite interesting. Over a 10% cash on cash return is the target, and then over a 20% average annualized return, meaning year over year. Usually the exit is the big piece, but averaged annualized over that hold, we're looking at over a 20% return yearly. So that's what we're acquiring. That's what we're interested in. And that's it. That's it from me. If you ever want to schedule time, this is my calendar link, and we'll leave it up to Carlos. Thank you.
We are a cost segregation company. We specialize in cost segregation studies, and we also do 45L energy tax credits. I was telling Adam this morning I can go 2 hours on cost seg and another 2 hours on 45L, but today we'll just do 2 hours on cost seg. I'm just kidding. It's getting windy. All right, so some housekeeping. I am not offering legal, tax, or financial or accounting advice. I am not a CPA. The information provided is for informational purposes only. You should consult your CPA, financial planner, tax advisor, or tax attorney before taking any action based on the information provided. And there's a form that we're passing out that you guys have to sign, and I'm kidding. All right, so why should I listen to Carlos why am I here instead of just hanging out at home, watching Friends, or whatever it is that you guys like to do on a chilly kind of Thursday evening, on a pre-Friday, as we say in Mexico? This is the reason. The average person spends 25 to 35% of their life working to pay taxes. That means more than 2 hours of every workday are dedicated to feeding your government. Yes. And 3 to 4 months out of every year are spent working solely so that you can pay taxes, and that adds up to over 13 years in your work life. That is a prison sentence. So I'm going to give you years back. That's the whole point on my presentation today. You're welcome. And I'm about to start singing that Moana song, the You're Welcome song. I forget what it's called, but all right, let's continue. Let's plow ahead. So cost segregation studies can help you reduce or eliminate your income tax by accelerating the depreciation on your investment properties. The best way that I can describe this is through a pizza pie. So your building basis, let me go back a little bit, just for example purposes. Building basis is, we arrive to the building basis conclusion by taking your purchase price minus the land, because land is a non-depreciable asset, and then we land on whatever the building basis is. So for example, if it was a purchase price of $1.2 million and the land is worth $200,000, we're dealing with a building basis of $1 million. So this is what the building basis would be. So it's a whole pizza pie. And what we do as cost segregation professionals is we carve out the components that are 5-year property, the components that are 7-year property, the components that are 15-year property, and you're always going to have 27.5-year property in residential or 39 in commercial, because you're always going to have the structural part of the business. Let me break it down a little bit more. So you're going to have your building, which on residential is 27.5 years, on commercial is 39 years. You're going to have your land improvements, which is your 15-year property, and you're going to have your personal property, which is your 5-year property and 7-year property. Now, where am I coming up with all these things? So the IRS many years ago came up with the Audit Technique Guide. The Audit Technique Guide is what we use as our Bible, as our baseline, as our reference guide in order for us to generate these cost segregation studies. And based on the Audit Technique Guide is that we are able to break down all the properties into the different components. So let's jump into it. So typically whenever we do these presentations, like we start and we get like really in depth on cost seg and all the technicality and all those aspects. And then all the way at the end, we show you guys an example. And then by that time, everyone's already zoned out, everyone's already semi-drunk, and nobody ever pays attention. So I'm starting like one of those Martin Scorsese movies. I'm starting like in the middle towards the end, and then I'm going to work my way back. Is that okay? All right, so this is an example of an apartment complex. So we have the property address. By the way, this is what we call an estimate of benefit. Whenever you call me and say, hey, Carlos, I'm thinking about buying this property, or hey, Carlos, I bought this property, I haven't done a cost seg on it, this is what I'm going to work on to give you an estimate of benefit so that you can get an idea of how much depreciation you can accelerate. So on this particular one, this is for an apartment complex. I wanted to do two, because I wanted to show you one as a residential property and one as a commercial property. So that way you can take a look at the difference between the two of them. So an apartment complex that was placed in service in July 1st, 2023. So for us cost segregation professionals, the only date that matters for us is the day you place the property in service. I have a good friend of mine out of Charleston, and this guy, like, he rocks the mullet. He always wears Hawaiian shirts. He's always wearing board shorts every time I see him. And he literally sent me an email on December 31st this last year. And it was a very formal email. Dear Carlos, I hereby engage U.S. tax advisors. Very declaration of independency type of email. And I called him the next day. I'm like, Nick, what the hell is this? And he's like, because I had to send you that email so that I could engage you, so that it could be noted that I wanted to do the cost seg for 2023. I'm like, what are you talking about, man? Go get a drink. Go smoke a joint or something. The only date that matters for us is the day the property was placed in service. So what that means is that if it's a property that, let's say that you bought it a few years ago, 2020, 2021, and you haven't yet depreciated it, that date in service is what's going to determine what type of depreciation that property is going to get. Meaning, if it's something that still falls within the lingo for it is a Trump tax reform plan, but the formal name, the Tax Cuts and Jobs Act, if it's something that falls within the Tax Cuts and Jobs Act, then guess what? Then you get to have 100% bonus depreciation. If it's something latter or something like in this case, then 2023 is an 80% bonus depreciation year. So you're going to get 80% bonus. Now, what do I mean by 80% bonus? What I mean is that out of the whole pizza pie that you're entitled between your 5 and your 15 year property, which is what you can accelerate, you can grab 80% of that on year one for 2023. Prior to that, it was 100% of that. So if the total depreciation, like in this case, if the total accelerated is 419,000, you could take the whole 419,000 on year one. So, but let's not get ahead of ourselves. Let's keep going here. So anyway, date placed in service. That's the date that matters. All right, so cost basis. What was the purchase price? In this case, the purchase price was 4.5 mil. And the land allocation is crucial because, again, land is a non-depreciable asset. So we want to make sure that we split them up so that we can arrive to whatever the building basis conclusion is, because based on whatever the building basis is, what we're going to carve out. Essentially, that's what we do in the most basic term. We carve out the components of a property. But in order for us to do that, we got to find out what that building basis is. So here the land allocation is based on the appraisal. So there's different ways that you can arrive to the land allocation conclusion. You can use county tax assessor records. You can use land allocation. And you can use a bunch of other ways that the IRS allows. Send me an email, shoot me a text, and I'll send you over that list on how you can determine what the land allocation could be. But on this case, we have the appraisal. So the appraisal says that the land is 57.65%. So what that does is that if I take the 4.5 minus the 2.5, I get to whatever my building base is going to be, which in this case is the 1.905750. From there, like I said, we carve everything out, and what we estimate based on a residential property is we're estimating that we're going to give you about 419,000 in accelerated depreciation. And then you could be like, what is that? Does the IRS owe me a check for 419,000? What do I do with that? What you do with this is that you use this as a loss to tackle your gross taxable income. So if your gross taxable income for 2023, I'm not going to use that particular example because I still got to 80% it. But let me go a little bit further down the road. Because 2023 is an 80% bonus depreciation year, I take the total accelerated, the total that we're finding between your 5 and your 15-year property, which are your short life assets. I'm grabbing 80% of that, and that is my 342, 335. And this is what Adam was showing earlier as of what he's entitled for in year one. What this means is if your gross taxable income and you're an active investor, which is key, for 2023 was 350,000, this just wiped out your gross taxable income by 342,000, and then therefore your gross taxable income is $8,000. That's essentially what it does. Now, yes, exactly. Now, what I always tell folks, if you're gonna write that big fat check to the IRS, give us a call first. But if we're able to save you money, make sure that you keep the money set aside so that you go to Adam and say, hey, Adam, I have an extra 50, 60, 70,000, let's invest at work. What can I do with this kind of money? So still leave it set aside so that you can invest that money. But essentially that is what that is. Now, this is all because 2023 is an 80% bonus depreciation year. So what this is right here is the breakdown of the different components within a property. So like I said, you're always gonna have the real property of the building. In this case, because it's an apartment complex, this is gonna be 27 and a half year. Then you're also going to have your 15-year property. Your 15-year property, those are the land improvements. Those are fencing, mulch beds, concrete, trees, shrubs. Yes, we actually have to count all the trees. Those are all the land improvements. Your 5-year property, that's what the IRS calls your personal property. It's typically all the items that go into fixing up a property so that it looks nice, like the lipstick on a pig kind of thing. That is your 5-year property. Your 5-year bucket, I call them buckets. I know that there's probably some fancier term, but I say buckets. Your 5-year bucket is always going to be your heaviest bucket. Like, for example, in this particular case, your 5-year bucket is giving you 323, and your 15-year bucket is giving you 95,000. So you can see how much heavier the 5-year bucket is. And the reason I'm saying this is because one of the things, whenever we have the original conversation with clients to see if their property will qualify for a cost seg, is like, are you planning on holding the property or are you planning on selling it right away? Because if you're thinking about selling it, then this might not apply to you. If you're thinking of at least holding it for those 5 years, you already got 70% of the benefit because you already accelerated 323,000 plus whatever 15-year property up to those 5 years plus whatever 27.5-year property for those 5 years. One of the things that is very crucial, a lot of people think that when you do accelerated depreciation, you lose all the 27.5-year property. You don't. The only thing that happens is that, going back to that pizza pie example, the 27.5-year property is now smaller because now we're breaking down all the components into their correct categories, which, by the way, is the way the IRS prefers things to be done. And by the way, this last column is if you were to just do straight line depreciation, which is something that my daughter can do. You take the purchase price minus land, you get to the building basis and divide it by 27.5, which is what most CPAs do because it's the easiest way to go about it. This is what it would look like. So there's a significant difference. So now a lot of our clients say, Carlos, if I add all the 5-year property, and if I add all the 15-year property, and if I add all the 27.5-year property, I get to the same building basis as if I straight line depreciated. And the answer is yes, it's supposed to be that way. We're not coming up with numbers out of thin air. We're just breaking down the property a different way. So at that point, it has to do with the velocity of time and with the velocity of money. Would you rather get $342,000 on year 1, or would you rather wait who knows how many years to get that $342,335, and by then, that $342,335 is probably going to be worth significantly less. So it has to do with what you can do now in order to take advantage of all those things. By the way, in many cases, clients are like, Carlos, I still don't get it. So what's the benefit? So what we do is we give you an example. All right, let's say that especially for us here in California, like this applies very well because taxes are so high here, that let's say that you're at a 40% tax bracket. So if you were at a 40% tax bracket, this is how much in savings that translates into. You're saving $167,700, and on year 1, just year 1 alone, you're saving $136,900. So that's the example that we give you, just so that we can help you land the concept a little bit more. Now, this is the exact same scenario, the exact same purchase price, but the only difference is that now this is a boutique hotel that was also placed in service in 2023. And I'll get into dates in service in a little bit as well. But this is the exact same scenario as far as purchase price goes and as far as building basis goes. But the difference is that the yield that you get on commercial property is typically much higher than in residential property, especially because there are some cases embedded into the residential side that heavily favors the IRS, so therefore you get to have a lower yield on a residential compared to a commercial property. So here you can see, like the other example that we just saw was $419,000 total accelerated. Here for the same property, you have $514,000 total accelerated. You have $332,000 on year 1 just because it's still an 80% bonus depreciation year. And here, instead of 27.5 years, you have your 39-year property. There's a significant benefit, and every structure is different. For example, if you do car washes, if you do gas stations, those are heavily mechanics. There's really not that much structure. Everything that's on the 39-year column goes over to the 15-year column, and therefore you can accelerate the entire property all at once. It's insane. When when clients see that, is I'm just buying car washes and gas stations nonstop. I'm like, yeah, do that. But so that's the gist of it. For example, so self-storage units, we estimate, like boutique hotels, we estimate them at 27%, which is normally on the lower side. So 27% meaning 27 out of the total building basis right here, 27% out of the total building basis is going to fall between the 5 and the 15-year category. So 27% is on the lower side. It's typically somewhere closer to 30. Residential properties, we estimate them closer to 22%. And that's more like on the higher end side of, like, typically residential properties, the highest is between 22 and 23%. But on commercial, it's significantly higher. Self-storage is even higher than that. Self-storage is 30%. So depending on the building type, the acceleration that you can give it. So let's plow ahead. And by the way, I'll have like a little Q&A section at the end if you guys have any questions. All right, so who should perform a cost seg study? So here are some pointers. Do you own investment real estate, either commercial or residential? Do you or will you need to write a check to Uncle Sam? Do you qualify as an active real estate investor, or do you plan on holding the property for at least a few years? These are 4 key questions that whenever we have the original conversation with our clients, we want to make sure that we address them, because believe it or not, because cost seg and the word cost seg is trending so much lately, we'll get a call, hey, I just saw you at an event in KW Wealth, and yeah, that looks really cool. How much are you paying taxes? Oh, I haven't paid taxes in a year, but I want to do a cost seg study. So you don't need me. You haven't written a check to Uncle Sam in a while. You don't need me at all. Do you qualify as an active real estate investor? This is a very significant one. And one of the reasons why whenever we generate an estimate of benefit for our clients, we say, hey, make sure that you run this by your CPA, because in many cases, they don't qualify as an active real estate investor. So I'm giving you losses that you might not even be able to take advantage of anyway. And so you really have to run it by your CPA just to make sure that it's something that, that is worth your while. And number 4, do you plan on holding on to the property for at least a few years? The reason this is important is because of depreciation recapture. So going back to our example, if you take 80% on year 1 on the 5-year property and the 15-year property, and you sell in year 3, there's a lot of the stuff here that has to be repaid. There's a lot of stuff here that has to be repaid, because originally you're not taking the depreciation title that you're entitled to for 2023. You're taking 80% of all the depreciation, so there's some depreciation recapture. So you want to make sure that you at least hold on to the property, like I said earlier, for at least 4 years. Some of my peers will say by year 4, by year 3 or 4, you're good. But I like to get the max benefit. So at least by this point, you already got, this bucket is almost empty. If you hold it for at least 5 years, that's great. That's great. All right, let's go to the next one. What properties are not good candidates for a cost seg study? Typically, I've seen properties with a building basis below $50,000. It starts to get very blurry, because we want to make sure that the cost, what you end up paying, and the benefit is 10x whatever the cost is. And in many cases, if it's below $50,000 building basis, it starts to get very blurry. So it's just, there's all these other factors that come into play. Have you done improvements to the property? Did you do a 1031 exchange? Have you been depreciating the property for a while? That sort of thing. And these are the other reasons. Properties where the 1031 exchange creates a wash. Hey, I bought a property for $200,000 from a 1031 exchange that, and the amount that came in from the exchange was $200,000. Then there's no meat there on the bones. So there's nothing for me to do. So that's why it's key for that. Now, in some cases, that person's CPA can come back and do additional calculations or whatever the CPA calculation is, and say, no, there's actually a little bit of meat on the bone. So let's take a look at that. But that will be something that your CPA will end up determining. And then, like I said earlier, properties that have been depreciated through straight line for a while. Well, why? Because if you've been depreciating a property for 14 years, by the time that you get to me, there's barely anything left. There's barely any meat on the bones again. I'll take your money. It might not be beneficial. And one that I forgot to mention here is your primary residence. You cannot depreciate your primary residence. I've been getting I've been involved in so many conversations around this. People trying to get creative. No, it's because I rent a room, and it's like, dude, don't depreciate your primary property. It has to be an investment property. It has to be on your depreciation schedule. When should I do a cost seg study for my property? It depends. So our industry is the devil's in the details type of industry. So it really depends when you should do. Ideally, you should do it as soon as you close escrow. That way, you haven't chipped anything out of the 5-year property or out of the 15-year property. So ideally is doing this as soon as you close escrow. And some of our long-term clients, they'll send us the closing statement as soon as they close. Like even before closing, they'll send us the appraisal. They'll have everything ready. So as soon as they close escrow, we go ahead and get the cost seg done. But it depends. Again, it goes back to, are you an active investor? Are you a passive investor? Are you able to take the losses? Are you capped on the losses? So it's a matter that we have to have a conversation on. All right, so types of studies. There's 2 types of studies. We have the full-on detail engineering-based cost segregation study. That's where, I physically go to the property. I'm measuring everything, measuring the square footage of the windows, and not so much for the windows, but we want to look at if you have Venetian blinds, if you have drapes. We're looking at everything. We're like hound dogs for a 5 and 15-year property. And we have the modeling method. The modeling method allows us to use our technology so that we can build a model of your property within our system and then break it down from there. So that is a much more cost-effective approach. Typically, for this one, you typically end up paying less than $1,000. And the way we gather the data is via modeling, meaning you are our boots on the ground. You are the one who gives us the appraisal, photos, video walkthrough if possible. But the way we give you the information, it's still the same way through both types of studies. So it's just the way we gather the data. And this modeling method works perfectly for properties with the building basis up to 750,000. Maybe here in San Diego, we can push it a little bit higher just because still your average 3-bedroom, 2-bath in San Carlos is still $1 million. So maybe here in San Diego, we can push it up a little bit, but it really depends, just like everything else. So that is the most popular one when it comes to residential properties. This is typically for 1 to 4 units, and we're looking for ideally condos, townhomes, cookie cutters type of properties. I had a client that bought a property in Connecticut for $500,000, and he's hey, this qualifies for the modeling. He sent me a Zillow link. It had basketball court, a pool, a game room. I'm like, this does not qualify for the modeling property. So it really depends, but typically, if it's a cookie cutter property, it should be able to fall under this, and it's a great way for you to take advantage of cost seg without having to pay the big ticket items. Now, the way our process works is we gather the information from you. We don't need that much information. Ideally, we can start generating a proposal based on literally the address. We do need the address. We do need the date you placed it in service. If it's a property that you place in service prior to 2020, we will need to essentially take a look at your depreciation schedule because we have to calculate how much depreciation you've already taken on the property and account for that as well. Because like I said earlier, in many cases, it's a situation where it's, it doesn't make sense because you've been depreciating the property for 10 years. There's nothing left there on the bones. So we gather the information from you. We generate a proposal. The proposal is going to have 2 important elements. Number 1, the estimate of benefit, like the one that I showed you guys earlier. And number 2, our fees. This is what our fees are going to look like. We custom price everything. We look at everything individually. Everything that we do is based on our engineering team's time. And therefore, we're a type of company that we are a best foot forward type of company, meaning we're not charging you 20% extra so that we can negotiate the price. We're giving you our best price up front. All of our studies include audit protection as well. Some of our peers, they charge a little extra, and whenever we have events, they're like, hey, how come you don't charge the audit protection? I'm like, why should I charge the customer extra so that I can guarantee them that I'm doing my job? So we don't do any extra fees for audit protection. And typically our turnaround time is about 3 to 4 weeks. There was one year where we were turning reports around I think it was like during the October extension deadline, around October 5th. We were literally turning, our turnaround time was like about a week. And a lot of our clients, like years later, hey, Carlos, why are you it's been 2 weeks, where's my report? I'm like, we did that once, and they're still chasing us because we're not fast enough. But 3 to 4 weeks is our average turnaround time. And then once we do that, you go back to your CPA and say, hey, this is what Carlos sent me. We're happy to jump on a call with your CPA. We do that all the time as well. So just because some CPAs are not too familiar with cost segs, so we walk them through it, especially if it's a property that you placed in service in a prior year. We assist you with the 3115. The 3115 is a form where you're officially telling the IRS, hey, I'm switching from straight line depreciation to actually breaking all the components down. And we help you with the 481A adjustment. The 481A adjustment is you telling the IRS, hey, based on this property that I placed in service back in 2021, this is how much depreciation you owe me. Let me tackle some common misconceptions. This is going to flag me for an audit. If I had a penny for the times that I've heard this one, oh man, I'd rather be able to sleep at night. This is going to flag me for an audit, or I'm going to automatically get audited. The thing, and I was talking to, we were talking about this just earlier. The thing about the tax code is all 5,800 pages of the tax code, 95% of it is intended in order so that you can save money, in order so that it incentivizes you to reinvest in other areas, energy, agricultural, real estate. And literally 5% of the tax code is actually about paying taxes. So the vast majority of the tax code is there for our help. So this is literally directly from the Audit Technique Guide. This is page 2 from the Audit Technique Guide that is published by the IRS. It says, an increasing number of taxpayers have submitted either original tax returns from claims for a refund with depreciation deductions based on the cost segregation studies. The underlying incentive for preparing these studies is for federal income tax purposes is the significant tax benefits derived from using shorter recovery periods and accelerated depreciation methods, including bonus depreciation and Internal Revenue Code, the good old 179D, for computing depreciation deductions. Let me go to this paragraph. Cost segregation studies are most commonly prepared for the allocation or reallocation of building costs to tangible personal property. Let me go to the last sentence, because it gets into 1250 and 1245. Therefore, a faster depreciation write-off and tax benefit can be obtained by allocating property costs to Section 1245 property. It's like literally right there, and it's the correct way to depreciate a property. Misconception number 2, this is only for properties with the building basis north of $1 million. I was just at an event, and the speaker was talking about this, and I wanted to just get up. I wanted to just get up and be like, hey man, that is not accurate. Like I said earlier, we can do it with properties with a building basis as low as $50,000. You can only go back 5 years. I've heard this one a lot too. Again, we are the devil's in the details type of industry. It depends on how aggressively you've been depreciating the property. We would need to take a look at it. In some cases, this is accurate. In some cases, this is extremely inaccurate. It really depends. 100% bonus depreciation is back. It's not back yet. We're hoping that it's going to come back. But again, I was at that event, and that same speaker said 100% bonus depreciation is back. Everybody started clapping and hugging each other like the Apollo 13 had just landed on the moon. No, it's not back yet. It passed the House back in January. We're hoping that it's going to pass the Senate. It is an election year, so election years are weird. So we'll see. Oh, that's it. That's it. Q&As, by the way, help me out. I just started my Instagram profile. I wanted to put just photos of my daughter, and they told me no, keep it business. So feel free to follow me. My whatever this thing is called Mr. Cost Seg. So that's it, guys. So based on that, I appreciate you guys' time, and if you guys have any questions, I'll hang out here or whatever direction Adam gives me. But yeah.
Carlos, you mentioned the criteria, right? The 4 or 5 criteria. And one of them was being an active investor. I know that's not your specialty, but can you kind of go into that more? Like, what does that entail?
Well, I mean, what we tell clients whenever we generate a proposal for you is take this proposal and run it by your CPA. Because in many cases, depending on the way you're structured and everything, if you're a passive investor, you might be limited to that 25K. I was telling someone earlier, I have a client that he's a doctor. He owns like a zillion properties in Danville, Kentucky, and I'm giving him $2 million in losses. And he's a doctor, so I know that he's not, and his wife is not a real estate professional. So I know that he's passive, and I'm like, hey man, I'm giving you a lot of losses, so make sure that you run it. And he's, yeah, my CPA says that's fine, because the devil's in the details. So it's just a matter of however your CPA and your tax strategist is setting everything up. What I tell people, 3 people that you need to have in your corner: a bookkeeper, a good CPA that's up and current with everything, and a tax strategist. So that's where the CPA/tax strategist will come into place. Yeah.
Carlos,
Yes.
along those same lines, as far as who this is for, I mean, you mentioned 4 different categories. Does the person have to check off all 4 of those boxes?
No.
Or either of the 4?
Yeah, no, it's the main thing is actually, let me go back here. That's a good question. I hadn't thought about it. Let me see. Did I? All right. Who should do it? So, do you own investment real estate? First, you got to make sure that you own investment real estate. Do you or will you need to write a check to the IRS? So this is typically what triggers the cost seg call. And then the part of an active real estate investor, that it's just like I was just telling him right now, it really just depends. I have a lot of clients that are passive and that we do studies for, but they get their CPA's blessing first. And number 4, do you plan on holding on to the property for at least a few years? This one is a big one because otherwise you're subject to depreciation recapture. And with 70% of CPAs heading out because they're all baby boomers in the next few years, if you have to do depreciation recapture, your CPA is going to fire you. Yes. Yeah, that's a great question. So if you guys didn't hear it, she said, is this something that you only do once or is this something that you do on an annual basis? So in essence, cost segregation is an engineering snapshot, like a camera, of that income event at that moment in time. So you do it once for the purchase, but let's say that it's a 20-unit apartment complex, and let's say that down the road you say, hey, you know what? I'm actually upgrading all the units and I'm spending $1 million in improvements. So then at that point we do what's called a capital expenditures report, where we take all those expenses and we allocate them in whatever category they belong to. So when it comes to improvements, or let's say that you buy a rental property and you're like, hey, I bought a rental property, but then I'm gonna spend $250,000 building an ADU. We gotta do it we gotta do the actual cost seg on the purchase, and then the improvements for the ADU, the construction costs, we gotta break those down. So every time you do some major improvements to the property, we gotta make sure that we allocate for that. Yeah. Yes.
Scenario for you. You have a primary home, and then I guess you're now going to claim it as a rental property. When can you be eligible for that?
Yeah, so if you're, hey, I'm moving out next month, so the property is going to come into service May 1st, 2024, then you can do the cost seg, and just the date in service is going to be whatever date the property goes to be rented. And again, run this by your CPA because I've heard so many things about the date in service. Some CPAs, for them, the date in service is the moment you collect your first check, the moment you get your first income coming in from that property. For others, is the moment you start marketing the property. That's the date in service. So it really depends. CPAs handle that differently. Typically, rule of thumb is when the tenant moves into the property and it's like, all right, the lease agreement starts May 1st, so May 1st is the day you place the property in service. Yeah. Adam.
Yeah, so a lot of these people are more on the passive real estate investing side. Maybe touch on like the benefits still as a passive estate investor. Like active, you can write off against ordinary income. Basically.
Right. The benefits on the passive side is, like I said, it really depends on your situation. More often than not, I do see that it makes sense for clients that invest passively and have a rental here and there to still take a lot of those losses. But it really depends on the situation and how their financials are being broken down. And I know that, again, I'm not a CPA, but something that I've seen. I know that for Airbnbs it's a little bit different as well, and it allows you to be more aggressive on the losses that you take. That comes into play as well. But yeah, more often than not, I do see that passive investors take advantage of doing the cost seg study, even though they're limited, because it depends on their situation.
Yeah, because they can write off against any other real estate income that they had within those buildings or other investments. Maybe they just sold a building, for instance.
Yeah.
Or if you're in a fund, for instance, and there was losses that you could take from the fund and
Yep.
you write it off against some other real estate gains and income.
Yeah, exactly. There's all sorts of scenarios where it makes sense. So it's definitely something that if you're a passive investor, don't say, oh, I'm just zoning out, this is not for me. Take that into account, run it by us, let us get you a proposal, and run that by your CPA so that then you can start strategizing based on that. Oh, awesome. I love the questions, guys. Cool.